presenters. The first one is Jennifer Kyle. She's the founder and CEO of Condor Software. Condor is the byproduct of consulting for life science companies, where she helps organizations stand up and scale financial operations related to R&D. Prior to founding Condor, Jennifer held management roles as Senior Director of Finance and Corporate Controller, serving as the finance partner with operations and IT. Before that, Jennifer was an auditor for Ernst & Young, where she gained valuable financial audit and SEC accounting experience on high-profile and complex engagements, including large public companies and IPOs. Jennifer received her bachelor's degree in business management and economics from the University of South Florida and holds a CPA license in the state of California. Our next presenter is John Baglien. He's a senior manager at KBF's Audit and Advisory Practice. John has a background in both public accounting and industry. He started his career at KPMG in Portland, where he served publicly traded technology and manufacturing companies for 6 years, as well as non-public companies, primarily in the healthcare space. In industry, his assistant controller and controller responsibilities included leading his teams in the recording and reporting of financial results, as well as coordinating the external financial statements audits. In these roles, John completed the implementations of ASC 606 and 842, among other technical accounting projects. He has extensive experience in SOX compliance in technical areas, including accounting for income taxes, information technology, share-based payments, and revenue. And Peter Buss. He focuses on serving public companies, venture-backed, and pre-public companies. Peter has built a niche in providing ASC 740 and other tax consulting services to over 20 public companies up and down the West Coast. Additionally, Peter oversees the corporate tax compliance team, handling income tax preparation for both public and private companies. Peter serves as the outsourced tax department for both public and large private companies in Portland, handling all tax-related matters for these companies. In many instances, Peter works as a liaison between the client and the Big Four audit firm on tax accounting matters. Working directly with the Big Four has allowed Peter to maintain and strengthen his technical proficiency in the area of ASC 740. Peter assists numerous companies on a routine basis with their tax purchase accounting issues and has developed a strong focus area in this area. Please welcome Jennifer, John, and Peter for today's presentation. And if you have questions for them, please type them into the chat box and we'll do Q&A at the end. And also, as always, please keep your microphones on mute so we don't have any distractions during the presentation. Before we get started, let me put that link to Leading with Tradition in the chat box, as I promised I would. Okay, and with that, I'm going to start sharing my slides, and the presenters, just let me know next slide when you are ready for me to move forward. Okay, presenters, can you see my slide?
We can.
Okay, excellent. All right, please take it away, Jennifer.
All right, well, big group here today. Everybody's excited about finance and accounting and tax. I know it's not the most fun topic, but you know, we need money to create life-saving treatments. So here we are. So what we're going to cover today for my area here is really helping you guys navigate through finance and accounting related issues when it comes to forecasting, putting together some financial statements, some scenarios, and really prepping you for you know, your fundraise and moving to the next stage in your development cycle. So on that, we're going to be looking at the valuation, some costs and managing risks, how to estimate and forecast these costs, how much capital is needed, what kind of expenses you should be looking at, managing risk, how to identify and test key risk early and inexpensively, and how to ask yourself some tough questions and figure out a no-go quickly. And then we'll go through some best practices to give you guys some information to take home with you as you're working with your accounting financial professionals on best practices with cash flow, accounting, and some pitfalls to avoid when you're trying to select and work with your CRO, and some accounting for clinical contracts. You can go to the next slide, Renee, please. Thanks. And can I get a show of hands? How many of you folks have gone through human clinical trials, either on your current venture or historically? Okay, so just one. Good to know. So when we go through, when we're looking at how to value your company, right, you're going to be looking at revenues, and you want to look at market size, growth, penetration of the product, your treatment units, and your price. And then you're going to have obviously some expenses, COGS, development cost, research, clinical development, and your selling, general, and admin. And then you've got some other cash flows, capital expenditures, maybe you're doing some manufacturing, or working capital change, so change in inventory, AR, AP, and taxes, right? And then so the equation there gives you your net cash flow, and then we discount it, and then it gives you your discounted net present value, which investors will use to value your organization. Now, the earlier you are, that blue line that shows risk adjustment at each stage. So if you are preclinical, you're going to have a higher risk ratio that's going to bring your valuation down. And then that risk ratio decreases over time as you move through development and as you enter in human clinical trials and you go through phase 1, 2, and 3. Next slide, Renee. So estimating and forecasting costs. These are some of your biggest areas, right? So research cost, identifying the remaining steps to IND, estimating your cost of remaining research steps. You've got development, formulation, engineering, any software, and then clinical development. How many patients do you need per phase? What's your anticipated timeline? And then trying to examine the issues. So depending on what treatment you're trying to build, what your risk profile is for patients. Is it a small population? Are you going after a rare disease? Are you going after something that's wide? So you want to look into how risky your patient population is, where you want to conduct the trials, and the risk of establishing your endpoints. And then we've got COGS, which is your expected dosing and the treatment, how much the COGS is you're estimating your COGS at what sales volume, and then sales and marketing, right? So are you going to be attracting hospitals or office-based physicians? Okay, so you guys are on the device side? I think I just got a comment.
Our attendees are in a wide variety. We've got medical device, we've got pharmaceuticals, general research, digital health, a lot of different areas. So I think it's, an overall discussion is perfectly appropriate.
Okay. All right. So on sales and marketing, right, you're going to be going after the hospitals, physicians, and you want to identify what, no worries, Mark. You want to understand what kind of sales force you're going to need, including your medical science liaisons and any potential market issues on patient education, direct to consumer marketing, and so forth. And hopefully you'll have what we call your brain trust. So as you're building your organization, you're going to be bringing on key advisors that are really experts, subject matter in these areas to help guide you and help navigate through some of these issues. Next slide. Manage risk, be proactive. entrepreneurs should always be biased towards no-go. I always say, personally, I want bad news fast. And you want to take a look and an objective view of your business and say, where are the risks? Even though you may want to develop something, should it be developed? And that's just the business of the development. So is the market big, right? Are you addressing pain points? And can it be developed into a product and service? And how strong is the science, right? And I think most of you folks on this call have probably already gone through that, and that's where you are today. You've got a good product, you know that there's a market, and now you're just trying to figure out the best way to build your treatments or your devices and build that brain trust, your advisors, and learn how to put all the pieces together to go out and get funding to be able to develop those the treatments. So here's some questions that you may want to ask yourself, and these slides will definitely be shared with you after the call, so you can go back and do some work on your own. But I won't go through all the questions here, but there's some questions on clinical risk, on commercial risk, and financial risk. And you'll want to go through and take a deep dive into all those risks, because they will probably be asked when you go out and raise capital. And it will really help put together your narrative and your story from a business use case. And thanks. And then one thing on that last slide is you want to de-risk as much as possible. So you may not have all the answers, and that's okay, but you're going to want to have a plan to say, even though we don't know this, here's how we're going to get this information, and here's how we're going to de-risk it. So now we're going to go into some of the cash flow forecasting and best practices. So it's clearly understand and articulate your detailed development plan. This is your primary use of funds, obviously. And you're going to want to directly link your development plan to how you're creating value, what milestones need to be achieved, and consider the activities to engage customers and validate commercial potential. And on cash flow, you want to, on the first 12 months, you're going to want to have a monthly burn and know how much you're spending each month. And then as you go beyond, you're going to want to look at just annual run rate in cash burn as you're going out 5 years, 10 years. And if your funds only make it to the next milestone required for next financing, you risk the running out of cash. And you never want to do that. Fundraising takes a lot of time, and you want to get back to building your business and building these treatments to help, all of us. And then give meaningful thought to each line, but don't obsess. So budgeting can drive great planning discussion. Valuation analysis can enable sensitivity in scenario to identify critical value drivers. Do not just use per patient cost when you're doing cash flow forecasting. Don't assign, maybe we need $350,000, for this role. It doesn't work. Think about exactly the core functions that you're going to need and put a price point on those functions. Next slide. On that note, so be specific and detailed, but do not use per head to encompass all costs. And yeah, the key point there is it won't tie to your development plan. So start with your development plan, think about what it's going to take to hit that next milestone, and then what key drivers you need to invest in to get you there. That's your value creation. And that's what your investors are going to want to see as well. And you need to know what activities you plan to do and what they'll cost. You probably don't have all the answers of what they will cost. That's why you go out and you talk to folks, and you'll talk to somebody from a CRO, or you'll talk to somebody from CMC, manufacturing, and say, what's it going to take to build this molecule or come up with a drug formulation, and just get an estimate. And be sure that you are raising enough capital to achieve what you promised. The last thing you want to do is raise capital, use the funds, and you haven't achieved the milestone and you ran out of money, because you're going to lose a lot of your leverage and a lot of your equity on being in that position, on trying to raise capital. Make reasonable assumptions about your headcount or key costs. So specify your headcount, hiring plan, how you're going to get there, any outside spending with specific studies, timeframes, costs, and any facilities, contractors, or business admin that you may need. Next slide. So cash flow forecasting and accounting is a bit different. Cash flow, you're looking at specifically the future, how you're going to get to that milestone, how you're going to create value. And when you're looking at accounting, you really need to be focused on the financial reporting, right? Because you need your base case, you need your actual results as your foundation to be able to forecast what you're going to need. And you're also going to need to provide actual financial statements to your investors as part of due diligence and ongoing in the business and as you establish your board. So as founders, don't do it yourself. I know early on you're probably doing everything that you can yourself, but this is one thing, outsource it. Start with a firm, if it's a bookkeeper or a fractional CFO, start with a firm to help set you up, because I see a lot of organizations that did not set it up the right way, and we'll get into it on a next slide on equity or clinical accruals, and it ends up getting them in trouble down the road later on. So allocate funds. On that note, allocate funds in the budget for your accounting and clinical finance. And when you're trying to find that organization, especially as you start entering into human clinical trials, do not just hire a general accountant. Find somebody that has direct experience managing human clinical trials in the finance area. And there's some prospective questions you can ask about, what experience do they have? How have they saved their organization money, et cetera. And you'll want to implement some systems. And we've got a list there: accounting systems, purchase orders, contract tracking, equity, budget, et cetera. Next slide. Some more accounting best practices. The biggest financial reporting risk, as I said earlier, when you are in an audit, and you will end up needing to be audited when you're taking significant funds from venture capital or you want to go public, stock-based compensation, tax provisions, revenue reporting with complicated collaboration agreements, and clinical accruals. Those are the 4 key areas that you'll want to look out for, and that's why you hire somebody that has experience in those fields. And then we're all busy. Try to do your financial statements monthly. If you can't do them monthly, do them quarterly. But I wouldn't do them any less than quarterly. And compare your actuals to budget, because you want to look at your run rate and you want to know sooner rather than later if you're projected to run out of cash. Don't wait until you're 1-2 quarters out of cash and then having to perform a fire drill trying to bring capital in to continue with your development efforts. Next slide. Okay, and here's some tools on evaluating CROs. Some of you may have already entered into contracts with your CROs, but you certainly will when you go into human clinical trials. And I see some organizations that just go with a CRO because they know the name, Syneos, PPD, IQVIA, and don't do that. Go through and make sure that it's the right CRO based on what you're trying to accomplish in the timeline. And I've seen, small to mid-sized biotech companies really take the grunt of cost inefficiencies from your CRO. When you're dealing with one clinical trial or a couple clinical trials, you're small fish to them, and the risk that you're going to be overpaying and have less quality is greater. So you really want to manage that risk and the capital. So here are some financial pitfalls to avoid, and some specific things you can do to help navigate through that. So having to negotiate with leverage and knowledge. Don't just take the contract for what it is from them. Negotiate, have somebody that has worked with them or worked with CROs to help on your behalf. This will save you millions of dollars. Do not process your own site payments. Don't do it. Just go work with a CRO, have them do it. It makes sense. It's a lot of administrative overhead and burden on your part, and it ends up costing you more by trying to do it yourself. Manage change orders. If you have a budget, one second. So if you have a budget for doing a clinical trial, I have not yet seen a situation where there's been no change order and the budget hasn't increased substantially from start to finish. So keep that in mind. Don't think because you have one work order that that's going to be what your final cost is. And review invoices carefully. Review those invoices. There are many errors in the invoices, and companies pay a lot of money when those errors go undetected. Thank you, Doug. Yes, contract research organization. And those are going to be the companies that's going to help you manage the clinical trial. You're going to have patient monitoring, site monitoring, medical, data management. You can either do it all yourself in-house, or you can have a CRO take care of it for you. And most small organizations will use the latter because of just the administrative burden in-house that would require, and then all of the processes and systems you would have to have in place. And then accounting for clinical contracts. Here's the best practice. And again, you can provide this to an accounting resource that you may have, but you're gonna wanna set up your clinical contracts in this way, calculate your expenses, reconcile it back to your CRO, accrue, no, it's a typo, accrue for costs, and then use that to be able to forecast. And that's it. I think I went way over, I apologize.
No worries at all. All right, next slide. Thanks, Jennifer.
Yeah.
Thank you, Jennifer. John, I'm hearing a little bit of a echo on your end. Can you say something?
Hello?
Yes, you sound better now. Okay, I'm going to put myself back on mute and take it away. Just tell me when you want me to advance the slide.
Next slide, please. All right, so Jennifer alluded to audit requirements, specifically for grants. Almost any government grant award that you will receive will come with some kind of reporting requirement. They may be consistent, they may be completely different, but they will be there. Next slide. The most common awards that we see in the biotech space relate to the National Institutes of Health, NIH. The features of these awards, it's extremely important that recipients submit their reporting on time and accurately, follow the procurement standards outlined by the granting agency, maintain internal controls over their programs, and then monitor any sub-recipients. So if you're receiving funds and then you're passing those funds down to another organization to assist with those projects and programs, you will still be accountable for how they use those funds. Next slide. So some best practices to set you up for success. So the first one, determine a company-wide process for applying and requesting grants and awards, and make sure accounting is informed at minimum. This seems really obvious, but if you think about an organization with a lot of different departments, if you don't have a design flow, you can have different departments within the same organization going after the same grants, or the funds that they're planning to use for the grants are the same, and so you end up with more funds than you can utilize and support. As far as the accounting angle, most of the data on actual expenditures incurred will come from accounting, or accounting will be pulling it. And there's nothing that accountants love less than getting a reporting notice from the granting agency and saying, what's this? Useful to keep accounting in the loop. Establish separate GL classifications for each grant. This ties into reporting. It's a lot easier as you are using expenses that are related to specific awards. If when you pull your reporting at the end, you can say, okay, this is the list of expenditures or potential expenditures to consider, rather than trying to dig through your full GL to find those. Developing a financial and accounting manual relates to the earlier slide about internal controls. Establishing process for releasing funds from restrictions. So this is more along saying, okay, how are you going to use up the funds that you've received that are that are limited to a specific use? So best practice is to say, okay, we're going to put these in an account and then peel them off over time, either via monthly journal entry, either via invoices, what have you. So establishing that process in advance is helpful, as well as think ahead to, okay, when this is audited, where will the support be located? And so if you say, okay, we know that it's a set number of journal entries, we save those down, we have them handy, set number of invoices, not necessarily something you need to do along the way, but at least be thinking about it as you utilize these grants. Avoid releasing funds at inception. So it's sometimes real convenient if you get a grant that you are 99% sure that you think you're going to use, to just release those all to the P&L and not worry about tracking them at that point, going through the process of looking at it every month or every quarter. Catch is plans can change, and especially in situations when you're working with, when it's based on assumptions of future activity. If that activity doesn't occur, you're put in a situation where you need to go try to scrub back through and remember to scrub back through to figure out how much of the restricted funds you actually used. And then maintain a monitoring process over outstanding funds. This is real helpful if you have the unused funds set up on one of your balance sheet recs. On your balance sheet recs to go through on a monthly or a quarterly basis when you're preparing your financials. It helps you, one, be aware of what's still out there, but also just kind of a reminder that it's something to keep track of. Next slide. All right, independent audit requirements. So an independent audit determines whether internal accounting and other controls provide reasonable assurance around the accuracy of of financial reporting, operations, that the recipient has complied with applicable laws, regulations, and other grant terms, resources are managed and used economically and efficiently, and desired results and objectives are being achieved effectively. And so this is similar to harkening back to the previous slide. If your processes and front end reporting are set up, this is a lot easier. Next slide. All right. On the governmental grant side, generally entities that expend $750,000 or more per year are required to have an annual independent audit under generally accepted governmental auditing standards. If your awards are all under one program, you can have either a organization-wide audit or a program-specific audit of the program. One thing to note is on the NIH Awards, if you want to go the program-specific auditor route, you need to obtain approval in advance. Next slide. So program-specific audits, as the name suggests, they only cover programs expending funds and avoid the entire organization being subject to audit. As it would suggest, it's less involved and also less costly, which of course is a plus. Next slide. Program-specific audits. So the audit reporting package must contain the financial statements and schedule of expenditures of federal awards, sometimes referred to as the CFA. An independent auditor's report, including an opinion on the financial statements and the schedule of expenditures of federal awards, report on compliance and internal control over financial reporting, and compliance with requirements applicable to each major program and the related internal controls. A schedule of findings and question costs, and if applicable, a summary of prior audit findings and a corrective action plan. Next slide. So schedule of findings and question costs. It's important to follow up and remediate these so that they don't appear in subsequent years, which can prompt action from the granting agency, as well as make it more difficult to get future grants. Question costs are costs that are questioned by the auditor because of an audit finding, either from a violation or possible violation of statute, regulation, or terms of the award, including matching funds, where the costs at the time of the audit are not supported by adequate documentation. So thinking back on the best practices, if you've got a process for monitoring the release of these awards and know where your support is saved, this is a lot easier to avoid having this happen than trying to true it up after the fact. Where costs incurred appear unreasonable and do not reflect the actions a prudent person would take in the circumstance. Next slide. That's it.
Thank you so much. Appreciate it. And Peter, it looks like this is your time to shine.
Yes, thank you, John. Thank you, Renee. So next slide, please. So on the tax side, you know, most early stage life science companies, whether it be med device, pharma, you name it, are typically not paying a lot of income taxes. And given that we're in Oregon, oftentimes aren't paying much in the way of sales and use taxes either. Even if you're in another state, most states, or at least a lot of states, have, you know, exemptions from use tax for certain research organizations that may apply as well. But for my slides, I really wanted to focus on things that impacted cash. And so what I thought we'd start out with is the refundable R&D credit. And I think a lot of people have heard of this. And you know, there's the R&D credit, which you claim in your tax return. And before 2015, you would calculate this credit based on your qualified research expenditures, which include wages, outside contractors, supplies are the three main categories that apply. And you come up with a credit and just kind of rule of thumb, somewhere in the 6 to 8% of your QREs, your qualified research expenditures, is the credit you'd expect to generate. You know, early stage, oftentimes, you know, companies are generating quite a bit of this. And we'll talk about funding here in a minute. But prior to 2015, those credits would be calculated, included in your tax return, and they would simply carry forward. And they would carry forward for up to 20 years. And unless you actually used all of the net operating losses that are often generated in the early years, and then ultimately get to those R&D credits, there wasn't a lot of cash impact, or if there was, it was so far down the line that it, you know, at that point, you didn't need the cash as much as you needed in those earlier stages. But in 2015, there was a change in the law which allowed for refundable R&D credits. And so we'll talk about who's eligible. Basically, it's companies with less than $5 million of gross receipts that didn't have gross receipts more than 5 years before the year in which you're claiming the refundable credit. And so a lot of early stage life science biotech companies do qualify for this for at least their first 5 years that they're in existence. Oftentimes they don't hit that $5 million threshold. They're spending all their money, you know, developing a product, a compound, what have you. And so we see this a lot. You can claim up to $250,000 a year of these refundable credits. And when you're looking at the test that I mentioned before, where you have to have less than $5 million of gross receipts, and you have to be within 5 years of the date you first generated gross receipts, the question came up, you know, quite a bit when this first came out is, what are gross receipts? and do things like interest income qualify as gross receipts? Does that really start the clock, or does it take actual revenue, third-party product type revenue? And unfortunately, gross receipts does include interest, and this is what catches a lot of the companies that I do work with, where they'll have some amount of fundraising, whether it be through grant or through actual VC type funding, and they'll generate just a small amount of interest income. Well, believe it or not, that actually does start the clock on this 5-year window you have. So if you do go through it on your return, on your income tax return, you calculate this credit, and you then apply at the bottom of the 6765, which is the form, to have that be treated as a refundable credit. Okay, you file that return, and then ultimately you end up claiming.
It's kind of just godly.
Oh, sorry. Then you basically claim this credit on the 941s, on your payroll reports, and it offsets the company side of FICA. And that's how you ultimately monetize these. So they don't actually cut you a check, but it does reduce your payroll taxes, which, on a dollar for dollar basis until you exhaust the amount of the credit that you generate. So it's again, impacting cash, important early on, and it's a great change for a lot of the, this particular industry to be able to monetize those credits early. When can you actually claim those? You claim those in the quarter after you file your income tax return. So for instance, if you were to file your income tax return today, which is in Q3, you would then claim these credits for the first time when you file your Q4 941, which would be in January of 2022. So there is a bit of a lag on these, and there's a separate form that it gets attached with the 941 kind of tracking the utilization of these credits as you use them. Let's see. In terms of funding, this is one where honestly we see a lot more of this in the Portland, Oregon market than I do, for instance, in the clients I serve out of the Bay Area or San Diego. A lot more of those companies seem like they're funded with VC backing versus as not quite as much in terms of NIH or regular grants. But up here we see a lot of grant revenue, and everyone should just be aware. I won't go into the detailed rules, but grant revenue, any sort of funding, basically offsets your qualified research expenditures for claiming the R&D credit. It gets complicated if the funding is say less than the total, or if it's bifurcated over different years. But that's a conversation you should be having with your accountant if you have these scenarios. But just be aware that if you're a fully funded by grant company, you may or may not even qualify for the R&D credit, depending on how that money's spent. Next slide. So another area that where I do see situations where companies are dealing with potential cash tax ramifications is around kind of grants and milestones. And this is oftentimes really a timing issue more than anything else. And in my opinion, anyway, there's nothing worse than getting an amount of revenue, either whether it be through a grant or through a milestone, which I asked the questions here, are those taxable? And the answer to both of those are yes, they are taxable. And so it comes down to timing. If you receive a grant up front and you're a cash basis taxpayer, or a milestone up front and you're a cash basis taxpayer, that is revenue on your tax return, that is income. And the question is, when are your expenses going to happen that in theory, most of the time, of course, are allotted to utilize all of the proceeds you receive from the grant or the milestone potentially as well. How do you match those up? And it can be problematic if you're a cash basis taxpayer. And that's where some of the things where I down here further on, how do you kind of manage the inclusion of that income? And if you are a cash basis taxpayer and you can time which fiscal year those payments do come in, that's the best way of managing that. Can you take a milestone and break it up over a certain period of years? Of course, bird in hand is the offset to this, right? It's nice to have the cash. It's nice to know that money's already in your bank account. But if you're going to have to pay a bunch of taxes because you take the entire allotment up front when your research expenditures are going to extend over a period of years, then maybe that's not the best strategy. You probably don't want that money to go to the government. You wanted that to be applied to the program you're running. And so, oftentimes there's a lot of structuring around payment terms. There's the other option of being an accrual basis taxpayer. And that's an election you can make on your tax return. You can't flip back and forth all the time, but you can make an election to move, for instance, from a cash basis taxpayer to an accrual method taxpayer on your return, which what that allows you to do to some extent is if you do get an amount up front and it's contingent upon providing certain future services, there can be the ability to defer that revenue and have it have a more matching approach with the expenses that it's intended to cover. And so that, again, that's a conversation to be having with your accountants. What is the right method of accounting to be on, cash versus accrual? How can you structure the terms of when you do get funding, whether it be a grant, a milestone, and how do you best match that up against the expenses that were designed to offset that? And then lastly, my last point here is talking about net operating losses and why this is even more important now than it used to be. You used to have the ability prior to 2017, or I guess it's December 2017, so 2018, to carry net operating losses that were generated, tax losses effectively on your C Corp tax return, to carry those back, okay? So what would happen every once in a while is I'd have a client that would get too much money in year one, and we weren't able to manage around this. And so we end up, believe it or not, paying some taxes federally. Well, in the next year, we would then lose money because the expenses actually came through. We had those expenses, and then we could carry that net operating loss back to recoup those federal taxes that we had paid. That's no longer available. There's some noise with the CARES Act last year in terms of allowing for some carryback, but generally just know that going forward, you're not going to have the ability to carry losses back. So that means if you pay tax in year one and then you lose money in year two, you can carry that loss in year two forward indefinitely at this point federally, but you have no ability to go back and recoup the taxes you paid in the prior year. So this is a big issue, another big cash issue potentially, and just something that needs to be managed. And then the last slide. So the last slide, another cash item that I want to throw out there is we're seeing more and more of this, and that is U.S. life science companies entering into licensing agreements with foreign entities. And everyone should just be aware that if you enter into a license agreement with a foreign entity, it's possible, depending on the tax treaty between the U.S. and that foreign jurisdiction, that there's withholding taxes that the person paying you, the payer, has to withhold in their own country and remit. You have no ability to go and get that money back from them. In theory, there's the ability to get a foreign tax credit in the US for the taxes paid to that foreign jurisdiction. The issue is that those foreign tax credits only carry forward for 10 years. So if you were to build up large net operating losses in the early years and weren't able to burn through all of those to get to the next layer, because there's an ordering, you use your net operating losses before you use your foreign tax credits, that it's possible that they expire before you're ever able to use those. And so that withholding taxes that is meant to be a net zero between two countries can become a permanent tax cash leak. And so, you want to avoid that if you can. Of course, you don't let the tax tail wag the dog. Sometimes we have to deal with this and just live with that leakage. But if you can avoid it, that's what we want to do. And some of that's just being aware that these foreign withholding taxes exist. And if you have the ability, can you structure around those? We've had a lot of scenarios come up where you'll have a large international or foreign company want to license a particular technology, but they happen to have a US subsidiary. And if you are able to convince them to contract with you through their US subsidiary, so the payment is not coming in from a foreign jurisdiction, that's one great way of eliminating this withholding tax leak that we're trying to manage. And there's other things that can be done, but that's the easiest. If it's possible, we want to manage on all of these different cash tax items and not waste the money to the governments when it's designed to, better your technology. And that's all I have, Renee.
Thank you so much, Peter. This is all really great information. Thank you, Peter, John, and Jennifer. Just taking a really complex topic and breaking it down into a lot of things that these folks need to know about. So thank you so much. As a reminder, these slides will be sent out to all the attendees, as well as a recording of this event. So with that, if you have questions, please put it in the chat, or you can raise your hand and I can open up your microphone. I'm going to go back through some of the questions that were received in the chat to make sure that everything was answered. Mel asked what a CRO was, and Jennifer answered that, and Doug answered that as well. Holly, you asked a question about CROs, and I think Jennifer may have answered that. Is there any more information that you need on that, Holly?
No, that was great. Thank you, Jennifer.
Good, great, thank you. And then Justin asked a question about managing the relationship with CROs. And Jennifer, did you answer Justin? You did. Justin, is there any more information that you need to know about that? Okay, I'm not hearing from him. And then Emmanuel.
Sorry, I answered.
Go ahead.
That's
Okay.
great. Thank you, Jennifer. I appreciate it.
Great. And Emmanuel asked a question about recommendations on local CFO consulting organizations that have expertise in this area. Jennifer, can you answer Emmanuel's question about recommendations on local CFO consulting? And he is in the Portland area.
Okay. Yeah, I'm not familiar in the Portland area. I know that there are definitely some firms that do CFO consulting that specialize in biotech. I'm happy to refer anybody. If you guys want to reach out to me, I can provide my email information and LinkedIn in the chat. Please feel free to reach out. I love life science, and I believe in all of you guys developing these treatments. So I'm happy to help out however I can. If it's just giving you some advice, some free advice, directing you to resources you don't have connections to, wherever I can help. I'll say that the short answer, though, is there's not really any tools available yet that are relatively inexpensive to help manage your CRO, but they're being developed today. So there will be soon. And in the meantime, it's going to be Excel models and best practices with a couple of companies that do the same thing that, Condor does, and some firms that specialize in internal audit and outsource accounting and CFO consulting.
Just quickly, there are some firms in town that have people who do have some of the expertise, Plus Point being one. Now CFO selections, they won't as a firm necessarily specialize within, life science or biotech, but they do have certain individuals that have some experience. And then Jennifer, the company that you know well, and that we work with a lot out of Southern California is Vandenboom, who does specialize specifically in the life science area. They serve probably hundreds of the clients we work with down in Southern California.
Great, thank you. And yeah, we do, Trotty does have a pool of accounting resources as well that we can always recommend to folks if they're asking about that. So thank you. Any other questions in the chat, or anyone want to just raise their hand and open up their microphone and ask? Feel free. We've got a few more minutes here. While we're waiting on any questions, I want to put up a post-program survey. I'm just going to launch this survey. If you would please answer it on your screen while we're waiting for questions. And I'll have that up there for about a minute. Thank you. We appreciate it. Wow, this was a really great topic and so much to know about. We could probably have hours and hours of presentations on this topic and still not get to everything. And what you all do is so very detailed and I'm sure that our attendees appreciate being able to get questions answered and know who to go to with questions about these topics that is, pretty far away from the wheelhouse that they're normally working in, accounting and financial forecasting. I'm going to leave the post-program survey up for just a few more seconds if everybody could answer it. Looks like pretty much everyone has answered, so I appreciate that. Okay, so we have another question in the chat from Jess. He says he has over 20 years experience in outsourcing CROs and other vendors for clinical trials, negotiating contracts and budgets, and can answer some of the vendor relationships about finding vendors. And he has his contact information, or she does, sorry, in the chat. I'm sorry, Jess, I apologize. Any other questions in the chat? Okay. Well, thank you so much. We appreciate your expertise today. We appreciate KBF for organizing this event. Alex Nelson was a huge help, and Peter and John. We appreciate Jennifer helping us out from Condor Software, and we appreciate KBF sponsoring this event, and we couldn't have done it without all of you. So we truly appreciate it, and we appreciate everyone's support of the OBI, and just love to have you participating in our programs. Please watch your emails tomorrow for the slide deck and a link to the recording so that you can look it over and share it with others. And if no one else has any other questions right now, we will close up today. Thanks again, Jennifer, Peter, John. Appreciate
Yes,
it.
thank you, Renee. Thanks for having us on today.
Yeah, absolutely.
Yes,
Okay.
thanks, guys.
All right, everybody go forward and have a great day and try to stay cool in this heat.
All right. Bye.
Thanks. Bye-bye.